I think we should move on to the next paper, and then we'll take a break after the next one. So Augustin and Ernst are both here, so I suggest we just go to the next paper. So the next paper is going to be presented by Augustin Landier from HEC Paris, and the title is ESG Investing: How to Optimize Impact.
Great, thank you. Can you guys hear me and see the slides?
Yes.
Yes, perfect. Okay, so let me start. So this is joint with Stefano Lovo, colleague from HEC. So the motivation, just to put a bit of perspective, so I think we all agree, you know, that negative externalities by corporations is a big theme on the agenda. So far, the traditional economic prescription has been to use Pigouvian taxes or, you know, pollution permits, cap and trade, basically. But the results have been somewhat disappointing, probably because of political economy reasons, you know, free riding among countries, political short-termism. After all, politicians have to be re-elected, lobbying frictions, etc. And actually in France, you know, the Yellow Jacket movement was actually started by the decision of the government to raise taxes on gasoline. So basically, you know, like that's what legitimates, in a sense, looking at whether the financing channel can, you know, be a way to have firms internalizing externalities. Well, there is a big rise of ESG finance. I'm not going to insist on that here, but I will insist instead of what is difficult to actually make sure that ESG investing does actually have an impact on the behavior of companies. And I think there are two main constraints that need to be addressed. The first one is to have competitive returns, you know, meaning that, of course, if you are willing to accept very low returns, you can have an impact by subsidizing companies to change what they do. But the question is, you know, like assuming that people are not willing to give up a lot on returns, is it still possible to have an impact on the behavior of companies? And the second difficulty, and it's actually related to the first one, is capital substitutability. So if ESG funds coordinate to ban some companies from their portfolio, those companies can actually decide to go elsewhere and try to basically just, you know, raise capital from agnostic investors, if you want. And so that channel can be very powerful and pretty much undo what ESG funds are trying to do. And actually, so among practitioners, this trade-off, so it's quite interesting. It's not always recognized, right? Many ESG funds are still under a kind of win-win doctrine where they say, look, we can actually do better by behaving well, by banning the vicious companies from the portfolio. And usually, you know, the assumption they make is that there is some kind of underreaction of the market to these themes. And so they make a bet, in a sense, that regulations will tighten, and therefore nicer companies are going to be the winners of tomorrow, and that the market is not aware of that. So it's kind of, you know, like heavy assumptions, basically, and it can definitely not be, I mean, maybe it's true temporarily, but it cannot be a foundation, a doctrine for ESG investing, because at some point that kind of underreaction is going to flip back, you know, and the cost of capital of dirty companies might go up, which means that actually the returns of these companies might be higher. And if you guys teach this, so there is an interview by Bill Gates where he basically phrases very well in very clear language this view that the substitution effect might be very big. He says, divestment to date probably has reduced about 0 tons of emissions. It's not like you have capital starved, the people making steel and gasoline. I don't know the mechanism of action they hope for. And so the goal of the paper is to try to think about whether there is a scope for impact without giving up much on the returns side. So there are many, I mean, we are part of a big literature. Let me just mention Heinkel, Krauss, Zechner, who were probably the first paper to model, you know, that channel whereby investors can have an impact on companies through their cost of capital. And I will also mention the paper by Martin and Marcus, which is here, with whom we share basically, I think, the same feeling that there is a lack of doctrine for, how does ESG have impact, and they look at it from a different angle from us, but with some common conclusions actually that show that a lot of what is seen as very natural in the ESG world might not be natural at all once you try to look for principles for it. So let me give you a little bit of a preview of the results. So the first part of the paper is an irrelevant result, namely that if there is no financial frictions, an ESG fund that has to produce competitive returns will have no impact. That's in a limit case where investors are not willing to give up on returns. Industry tilts alone by themselves has no impact. So just boycotting some industry or saying I don't invest in coal will not change basically, how much this sector pollutes. The environmental footprint of a fund portfolio is not a good measure of its impact. And then impact requires defining sensible pollution limits, sensible in that it is actually rational for companies to comply with those limits, and committing to financing only the firms that are compliant with those limits. And then the last one is about the supply chain. So I will show in a way that I think is quite natural that you can actually amplify your impact quite a lot by putting restrictions on the kind of suppliers that the companies where you invest are using. And so basically this indirect channel is going to be an amplifier for the impact that you can have as an investor. So I will first show you the baseline model with direct incentives, meaning that you only, as an ESG investor, only put constraints on what the companies where you invest do. Yeah, sorry. Yeah. Hello. Okay, let me continue. So then I will speak about indirect incentives, where basically I will explore this amplification for the supply chain, and then I will wrap up with practical implications. Okay, so it's a general equilibrium model with an economy with two sectors. So you have two goods. They are both used for consumption and production. So the reason I need that is because I want to have this input-output matrix, right, for modeling the supply chain. So we have a mass one of atomistic entrepreneurs. They have an ability to run a firm, only one firm, and they have no initial wealth. So they will need to go to the capital market to find wealth. So conditional on them finding one unit of capital, their production function is the following. It's a function of the pollution they emit, EI, and the intermediary goods from the other sector that they use as an input, XIJ. Okay, and so basically I use a Cobb-Douglas function here just for the purpose of having closed form solutions, but basically the functional form does not matter very much here, except that we need concavity for the equilibrium to exist. So the level of pollution, I'm going to assume it's between 0 and 1. So the maximum pollution, that's, if you just don't care about pollution, then you pick the technology that, is the most efficient, and your level of pollution will be 1. And so the question is, okay, if I want to curb my pollution, I need to give up a bit on efficiency, and I will have an output that is a bit smaller. Okay, now let's turn to the capital side. So we have a mass one of atomistic capitalists. They are each endowed with 1 unit of capital, and they are going to delegate their portfolio choice to competitive intermediaries that compete to basically attract their capital. So there will be regular funds that just maximize returns, and there will be an ESG fund which is willing to, on top of that, maximize social welfare. And I will specify very precisely what I mean by that in a minute. So to make that clear, so what are the preferences of individuals? So the type of utility functions we have in mind are consequentialist, in the sense that we assume that investors care about impact, and impact is basically a measure of welfare when they invest and welfare when they don't invest. So it's really basically like they attribute to their actions a fraction of what the ESG fund is able to achieve as a change between welfare in equilibrium versus welfare in a laissez-faire economy with no ESG fund. Okay, so I will have to compute basically this impact by the ESG fund, and each investor basically attributes to herself a fraction of that impact that is proportional to the capital that it has contributed to the ESG fund. And this parameter mu, but if it's equal to 0, then we are back to standard selfish preferences. So they are standard except for the denominator. Here I introduce this utility from aggregate pollution. So big EI is the sum of all the small EIs, namely the pollution of each individual firm in sector I. Okay, and so I distinguish E1 and E2. So these are the two sectors. You could add them up if you want, but here it allows for them to be different types of pollution. It could be radioactivity on the nuclear sector, for example, and carbon emissions on the coal industry sector. Okay. So in the talk, so to simplify things, I'm going to consider a corner case, a limit case, where I will assume that mu goes to 0. So think about it as lexicographic preferences, meaning that people, you know, they really want to maximize their returns, and conditional on having the same returns, they are looking for, you know, I mean, they are inclined to give their money to a fund that has more impact. Okay, so that's going to be a limit case, and I will take the share, I mean, the total amount of capital that will be collected by the ESG fund as exogenous. So that's going to simplify the exposition, and also it's a way to show that even in that limit case, actually the ESG fund can have an impact. Okay, so here is the timing. So first, each capitalist chooses whether they invest with the ESG fund or the non-ESG fund. Then the ESG fund is going to announce first the weights it is going to allocate in each industry, and second, the emission limits it is imposing for a company to be eligible to its capital. So basically it says, look, I'm not going to lend money to entrepreneurs who are polluting more than E1 hat in industry 1 and E2 hat in industry 2. It will turn out to be optimal, and that's quite obvious, to have different pollution limits in different industries. Okay, so then entrepreneurs choose in what industry they want to start a company, and they choose the technology of their firm. So an assumption here is that actually that choice is irreversible. Then capital and entrepreneurs are matched on a market that will have a matching friction that I will describe in a sec. And then production occurs, profits are shared between entrepreneurs and capitalists. And now, you know, like both types, they just become, you know, households who consume goods, basically facing the same prices in the same market. So let me speak about the matching friction. So I'm going to assume that if you comply with what the ESG fund wants, so because, you know, there is a mass 1 of capitalists and a mass 1 of entrepreneurs, then you will get financing with probability 1 because everybody is basically willing to finance you. Now, if you don't comply with the restrictions that the ESG fund is imposing, then you take the risk that it's going to take time for you to find capital. And so the way we model that is that we assume that you will get financed only with a probability that is smaller than 1, and that is proportional to 1 minus SI, where SI is the fraction of capital in the pool of capital dedicated to industry I, which is ESG, divided by 1 minus eta I times SI. And eta I is a measure of the matching efficiency in sector I. So if the market is perfect, eta I is equal to 1. It means that, you know, even if you don't comply, you will end up finding capital. If eta is equal to 0, then it means you find capital with probability 1 minus SI when you don't comply, which means that basically you have only one draw from the pool of capital, okay? And then if you get unlucky and you find a capitalist that is not willing to finance you because your production function is too dirty, then you just, you have no second chance. Okay, so eta I is a way to index, basically to have a range between this perfect efficiency versus only one chance cases. Okay. So now what is an equilibrium? So an equilibrium, it's a system of prices for the goods, a vector of prices, and a vector of fund returns. So returns, if I invest in a non-ESG fund dedicated to industry 1, a non-ESG fund dedicated to industry 2, or the ESG fund. And in equilibrium, if the ESG fund doesn't have zero capital, then these three returns have to be equal. So all individuals maximize their utility, they take prices as given. That's why there is an externality. I mean, they don't internalize their impact. Markets have to clear. And I assume the ESG fund, conditional on its amount of capital, is going to rationally, like choose its policy such as to maximize impact on social welfare. And so the goal of the paper is to basically like figure out, what's the optimal allocation and the optimal caps that you can impose on companies, and what does it depend on. So here, given we have assumed Cobb-Douglas functions, actually, it helps a lot. I think it doesn't change the fundamental forces, but it helps a lot characterizing the equilibrium, for a reason that here, basically, the amount of ESG capital is not going to change the relative size of industries. That relative size is going to depend purely on exogenous parameters. And so in equilibrium, if the ESG fund does exist, all the funds and all the industries will provide the same return on capital. That only depends on exogenous parameters. And social welfare, I will be able to compute social welfare just by, if you tell me, what is the equilibrium amount of pollution of industry 1 and industry 2, then I will be able to directly compute social welfare. So that's going to facilitate a lot the computation of the equilibrium. So let me just describe laissez-faire. So imagine there is no ESG fund that cares about externalities. So here, basically, everybody is going to pollute their maximum level. So E1 will be equal to E2 will be equal to 1. And the utility will therefore be 1, where there is a lot of aggregate pollution in the atmosphere. Now, what is the first best? The first best can be computing just by optimizing this function I've shown you here. And so if you do that, you end up with an EI star that trade-offs between the efficiency of polluting in a given industry, and that depends on beta, versus how much pollution from that industry is harmful in the utility of people, and that's the delta term that is here. It also depends on whether it's an industry that is useful as an input for other industries, right? So the more that industry is useful, the more costly it is to put harsh restrictions on that industry, even in the first best. Okay. So now let's think about the choice by the entrepreneur of the level of pollution it chooses for the technology of its company, of her company. So if the entrepreneur decides to comply with the requirement of the ESG fund, then its level of production is going to be E to the exponent beta. And so basically it's clear that for a given limit that is imposed to her, but the entrepreneur is going to choose that threshold itself, right? Because that's the maximum it can pollute, and therefore the more money it can make while being compliant. Now, if you choose to not comply, so to have a level of pollution above the threshold imposed by the ESG capitalists, then you are not doomed to not produce, but you will produce only with a probability that is smaller than 1, which is here. But you will produce more, and so actually this term should be 1 here, meaning that you are going to. No, sorry, it's not 1, so it's EI exponent beta, and you see that you will actually choose EI equal to 1 because there is no reason, there is nothing that actually makes it attractive to not choose maximum pollution. Okay, and so with that in mind, basically that gives us a first constraint, which is the highest threshold that the ESG capitalist can impose on an industry while making sure that entrepreneurs are actually going to comply with that threshold. So they will comply if basically entrepreneurs in sector I are indifferent between complying, which is what they get on the right-hand side, versus not complying, which is what they get on the left-hand side, and where basically, like finding capital is a bit more difficult for them. Okay, so now we can solve for the optimal problem of the ESG fund. So they maximize aggregate utility in this economy. What they have to choose is the threshold that they impose to companies under 2 constraints. One is the compliance constraint, which says that these limits have to be reasonable enough that entrepreneurs actually want to comply with them. and their portfolio constraint, which states that, you know, the sum of the capital they invest in industry 1 and industry 2, it has to add up with S, which is the amount they collected ex ante. Okay, so the first result is a specialization result, which says that, you know, in this setup, unless the ESG fund is really large, it should pick its battles and specialize in one sector so that it's going to be a big fish in that sector and really curb emissions in that sector. So for a small fund, I mean, if the aggregate ESG capital is small, it should coordinate its battles on one industry. Then there is a medium range where the ESG pool of capital is big enough that actually it should try to be present in several sectors. And then there is a range that is actually like strictly, you know, like strictly smaller than 1, where actually ESG investors are able to implement the first best, even though they don't have 100% of the capital in the economy. Let me try to describe graphically what happens in this economy. So you have 3 zones here. The first zone, which corresponds to a small ESG fund. So on the horizontal axis, you have S, the total amount of capital managed by the ESG fund. If that amount of capital is small enough, you see that in green, you have the level of emissions that are going to be imposed and implemented by the ESG fund. And so you see that it's going to focus the ESG fund on curbing emissions in only one sector. In that example, it's sector 2. But it leaves the emissions in sector 1 unchanged, and actually they, you know, saturate the constraint of being equal to 1, which is the maximum level of emissions that is allowed. Okay, so then we enter a zone where the ESG fund is going to actually curb the emissions in both sectors and invest in both. And then you have a third zone where we have a plateau of, you know, like the welfare improvement that the ESG fund is inducing, and actually basically the emission thresholds do not change anymore and we achieve the first best. So U in blue is the aggregate welfare. You see that it is kind of obviously increasing with the ESG fund, and it is strictly monotonic up to a threshold where basically we achieve first best. We cannot do better than that. And then, so what's interesting is that it's an economy where ESG investors are going to improve welfare by reducing the GDP. So aggregate consumption goes down, and actually in both sectors it goes down. So even when ESG investors do not try to impose restrictions on sector 1, you see that the consumption of good 1 goes down simply because people are poorer, right? So the constraints imposed on sector 2 are going to also have an impact on the aggregate output of sector 1. So that's what happens in equilibrium. And one nice outcome of this specification is a rule to tell you in what sectors you want to specialize as the ESG fund. How do you pick the sector where you should focus and intervene if we focus on the case of a small ESG fund? So basically, there are 3 effects to take into account. The first one is you want to pick a sector where actually there is a big gain in economic efficiency from reducing pollution. And that's going to be determined by the gap between laissez-faire level of emission, which is 1, versus the first best level of emission, which is E star. Okay, so that can depend both on the toxicity of the pollution in that sector and on how much it is needed in the production process. And the second term, which is the interesting one, which really makes the ESG fund different from a central planner, is how much grip it has on the entrepreneur. And that grip, it can be decomposed in 2 effects. So one is exogenous, it's the size of the financial friction that is assumed in that sector. So that's captured by eta. And the second one is the size of the sector. And here the idea is, you know, as a fund, you can decide to focus on a small sector so that you become a big fish in a small pond. And, you know, like entrepreneurs in that small sector are actually not going to ignore you. They are going to acknowledge that, you know, you put restrictions. They will listen basically to the constraints that you put, because ignoring them will be for them basically not having access to a large fraction of the pool of capital, which is costly for them ex ante. Okay, so these are the three ingredients that are important to, in a sense, choose how to pick your battles. Now let me, in the 5 minutes, okay. So let me say a few words on indirect emissions, and then I will wrap up. So far, I've just focused on the restrictions that the fund is putting on the emissions that the firm itself is doing. But we can also put restrictions potentially on emissions of customers and emissions of suppliers. So let me focus on emission of suppliers. Actually, emission of customers, it's even more powerful, but too much in a sense. In the model, you can actually have a massive impact. So let me focus on the supplier. So imagine that, okay, now I can put restrictions on the list of suppliers that you have to use if you want to have access to the ESG fund capital. And so the question we ask is, can it be optimal for the ESG fund to impose both direct and indirect incentives? So what happens, it's interesting, it creates an endogenous split of one sector between a clean subsegment of that sector and a dirty subsegment of that sector. So you end up, so I will take the example where that happens to sector one. So sector one here is going to become endogenously split between companies that choose to be clean, companies that choose to remain dirty, and regular funds are going to provide capital to both clean and dirty companies. The ESG fund is going to finance purely sector two, actually, and curb sector one indirectly through constraints on what sector two can use as suppliers. And then the consumers here, I assume they don't care. They basically use the cheapest goods they can. And so in equilibrium, it's actually going to be the dirty good, because it's actually more cheap to produce, is going to be the cheapest one in equilibrium always. And so the characterization of the equilibrium, it's pretty much the same, except that we have one new parameter, which is the price of the dirty good. And so we need one additional equation, and that additional equation is this one, the second one. It tells us that in the sector that is split in two, entrepreneurs have to be indifferent between producing the dirty good or producing the clean good. In both cases, they are not going to get ESG capital. They are going to be financed by agnostic investors. And so just to give you the particular case of what we show, if we again focus on a small ESG fund that is a bit like infinitesimal vis-a-vis the aggregate capital market, then we characterize what it should do. So it should, in the case of its possible access to indirect restrictions, it should invest all its capital in the industry that has the highest capital market friction, and then it should put an emission cap only on the emissions of the priority sector, namely the one where it is the most efficient economically to reduce emissions. And that cap is going to be direct if it turns out that that sector coincides with the sector with the highest friction, or it will be an indirect emission if it's the other sector. So let me stop there, and I will basically, I think my time is over, isn't it?
You have 1.5 more minutes, but
okay. Up to you. I mean, I can wrap up very quickly.
Choose wisely. I don't know. We can take a couple of questions or have. All right. So then let's go to the discussant. Thank you very much, Augustin.
Thank you.
The discussant is Ernst Maug from the University of Mannheim Business School.
Okay, thank you very much. Thanks for the organizers for letting me discuss this really interesting paper. So I would first like to say this is a really great paper. Now, this is these days a bland statement because all discussants say that, but I think I really like that this is a simple model. Everything can be solved in closed form. It's a clean analysis, and I think it makes a number of really important points. So I could stop there, but I really have kind of a difficult personal take on this paper. I really love the paper, but I don't love the spin. So I have a very different kind of takeaway from this paper than I think what the authors have. So I think the authors can keep all of the main analysis of the paper, but I want them to rewrite the title, the introduction, and the conclusion. So let's go back. What is the question we're asking? The question that is asked in this paper is a really important question, and that is, what if the market fails? Then we want to find an effective mechanism to address the externalities in production. So how do we typically think about it? We think about the government, for example, Pigouvian taxes to fix the price system, but that in many cases doesn't work. Then we could have regulation that could impose technology. That requires even more knowledge on the part of the regulator and is fraught with even more problems. So Augustin in his slides had a few points about why on many cases government performance in this area is unsatisfactory. Now, then the question is, what if the political process does not work? Then the alternative is we have choices by socially conscientious executives who implement corporate social responsibility, consumers or investors. And this paper focuses on investors. And it does something that is really fascinating. It looks at a model where investors first demand a competitive return, but then some of them are sensitive to externalities, but the preferences are lexicographic. So really the first order criterion they apply is still, they want to maximize returns. So if there are sufficiently many of them, then the first best may actually even obtain. And this is where, as a reader, I step back and say, wow, this is magic. So first, we wanted to introduce the government in order to fix the market, because the market didn't work. Then we realized that the political process doesn't work. And now we are asking the market to fix itself. So we are introducing kind of a new type of actor in the market that not only improves things a little bit much of the time, but actually implements the first best. And so I want to know what the magic is. So as a reader, I could stop here. As a discussant, I have to do my duties and ask, where does a rabbit go into the hat? Kind of where's the magic in this paper? So let's go through this step by step. How does this actually work? So let me just rehearse the narrative of the argument. So Augustin gave a kind of very detailed discussion of the math and how this works. So first part, we have an economy with investors and entrepreneurs, and they are also consumers, and they're all atomistic. So nobody has any power, standard. Then we have investors who choose funds. Some of them are socially responsible and some are not. That's good. Then we have funds who allocate capital to firms and firms that create externalities in production. That's going to probably standardware in this kind of paper. And then we have a socially responsible ESG fund that allocates capital only to firms that reduce emissions and demands a competitive return. So we do not even kind of introduce a trick here, like having some investors, for example, sacrifice some returns in order to have the fund address some externalities. So it's really, up to this point, everything is extremely standard. And that's what I really love about this paper, because I think what the paper does is it develops a theory of ESG investing where almost all of the ingredients are so standard that, that you cannot question them. So I just make a tick mark on them. But then we have two assumptions where I think we need to dig into. The first one, I think, which looks like a simplification, but I think it's not, is that we have only one ESG fund. So if there is any collective action problem to be solved here, at some point, I think there is an issue that we have only one fund that now kind of serves as a coordinating device. The second thing is that entrepreneurs to reduce emissions to retain access to an ESG fund, because there is a surge friction in the financial markets, so they can't kind of costlessly substitute for capital. So we have a surge friction and therefore a friction in capital markets, which means that a single fund, even though the fund has investors that want to earn a competitive return, has actually some kind of discretionary power over these entrepreneurs. So these are the issues I would like to talk about. So let me comment. Comment number one. Welfare is maximized if the single ESG fund allocates its capital optimally. So let me go through the solution that Augustin presented mathematically. So if there is very little ESG capital, then it should invest in only one industry in order to maximize its impact. If there is a little more ESG capital to go around, ESG capital is my shorthand for the number of investors who are basically having these lexicographic preferences, then the fund should invest in both industries. And in this case, there is an optimality condition. So the fund should then equate the marginal impact on welfare in each industry. So that's actually a pretty complicated expression to solve. It's not mathematically super complicated, but conceptually what it has to think about is what is the impact on the entrepreneurs and what is the impact of the entrepreneurs on emissions and what is the impact of this particular type of emissions in that industry on aggregate welfare. So solving this kind of marginal optimality condition is actually very involved. So it requires that the ESG fund actually knows the marginal impact of capital on emissions in each industry and the marginal cost of emissions in each industry on welfare. So for me, the ESG fund solves a lot of issues in this economy. So it determines the achievable second best if social responsible capital is limited. So I think there's a lot of central planning. So there's a lot of planification here. So I put a picture of Jean Monnet, who was the head of the of central planning in France after World War II. So I think he would love your approach. He would love your paper. So so because your ESG fund is basically like the Commissariat General that he was heading in the 1940s. I have a lot of questions here. So let me reveal my colors here. So I asked the question that I think is the real question that Milton Friedman asked in a famous article almost exactly 50 years ago. How can one, even the very sophisticated investor in this case, so he was addressing, of course, slightly different agents, but I paraphrase him. How can one, even a very sophisticated investor, solve this problem if the government cannot? So, of course, we can provide a list of government failures, but all these government failures have a reason. So it's not like they are kind of just evil people sitting in the government, and that's why it kind of all falls apart. There are reasons why governments can't get their act together, and all these reasons all of a sudden kind of fall into the background, and this magic fund can all of a sudden address a lot of these problems. So much more a Monnet world than a Friedman world. That's where I'm skeptical. There's a second issue, and that is coordination. There's only one ESG fund. I think I would like you to go through an extension where there are multiple ESG funds that compete for the capital of the socially sensitive investors and for the return. And we still maintain that our investors have these lexicographic returns. So then welfare depends on the aggregate allocation. So this is, you haven't solved this, but this is, I think, what I think would come out. The welfare would still depend on the optimal aggregate allocation of capital across industry. That is, if socially responsible capital is scarce, then all funds in this economy must coordinate to invest in the same industry with the same emission target. Alternatively, if you have a little more socially responsible capital go around, then this socially responsible capital should be invested in multiple, like in your case, 2 industry, but then they must kind of optimally solve this aggregate condition. So the funds must coordinate their investments so that they agree with the aggregate optimality conditions. And I asked myself, how are these conditions going to be decentralized? So how are we thinking about an economy in which this central planning problem is solved if we have multiple decentralized decision makers? I think that's a problem that you need to address. Finally, I think we have enormously sophisticated investors here. So the optimal capital allocation depends on the impact of capital allocation. And if you ask me, this discussion, which I think unfortunately Augustin put very little emphasis on in the presentation, I think actually that's for me is the core of the paper and the one that I thought was really stunning and something that I think I really took away from reading this paper. So there is corollary one, which I think should be upgraded to a proposition, which says that just allocating capital towards cleaner industry actually has zero impact. I think actually that's a very important result, because I think that's also kind of back in some of these questions. Shouldn't kind of the conscientious investors, shouldn't they kind of allocate just their capital to industries that have a better carbon footprint? But even within industry, you have proposition 4, which I would like to sharpen a little bit. It says the ESG fund may have a higher footprint than a regular fund. That is, if you have a socially conscientious fund, it may still have a higher carbon footprint that is kind of worse or kind of ecological parameters than a regular fund, because a footprint has nothing to do with impact. You want to allocate capital optimally in this fund, or you want the fund to allocate capital optimally to entrepreneurs to maximize impact. That is to get the potentially extremely dirty producers to become moderately dirty, which can be much more beneficial than going somewhere where everything is already clean. So that means the ESG fund by the investor is really evaluated based on a counterfactual, because it is based on the emissions with socially sensitive capital allocations relative to emissions without such a capital allocation. So as an investor in such a fund, I must understand that, yeah, I'm investing in lots of dirty companies, but if I wouldn't be doing this, that the world would be so much worse. So I come to that as a consequence, individual investors really have to be very sophisticated here. They have to understand that they should optimally invest in a fund that invests in dirty industry, like, for example, power generation, where the fund pushes the providers towards, for example, efficient coal-powered power plants, which are kind of moderately dirty compared to the really badly dirty ones, say lignite, because they understand the counterfactual that the alternatives would be so much worse. So I think that's putting an extremely high bar on individual investors. There's another thing that I think kind of
seconds.
Sorry?
We're already out of time, so maybe 30 seconds.
Can you give me 1 more minute?
Sure.
Until, okay. So last question, what if some investors are Kantian rather than consequentialist? So for example, they simply have a principle for clean industries and technologies. So they don't understand trade-offs, they don't understand counterfactuals. So what would happen, for example, if the investors in your economy would use footprint, for example, as you define it, to allocate capital? So I think that would be an interesting thing to also look at and analyze. I'm going to skip this slide and go to my summary because I'm running out of paper. I think this is a great paper. My personal takeaways are a little bit different from the author's takeaways. So my takeaway is that effective ESG investing is probably not going to work, because what the paper shows is that the bar is too demanding, it's too high. The conditions on funds and investors and what they need to understand are extreme. Complex conditions for the allocation of capital, achievable second best, and the counterfactual. Coordination problems, they need to subscribe to consequentialist ethics. So my recommendation is to change the how-to spin of the paper to kind of where is the bar for effective ESG investment. And I think the answer to me is probably much more skeptical and negative than the authors may sound it. But I think this is a paper that really kind of allows us to analyze the issue and actually understand them. And that's why I think it's still a fantastic paper. Thank you very much.
Thank you, Ernst. Augustin, would you like to comment and maybe?
So thanks a lot. Sure. Thanks a lot, Ernst. So great discussion. I mean, all your points are valid, and you are right that it's important to emphasize that this doctrine of ESG, in a sense, requires a pretty big amount of coordination. So I agree, it's sort of assumed that they all coordinate on common standards, this fund. So there could be many of them, but we assume basically that they manage to reach agreement on what is their common choice for the standards they apply. And also, it's not a decentralized approach. So it's true that it requires them to compute the thresholds EHAT. So here we could discuss a bit what happens if they make mistakes in a sense on the EHAT. I think I understand your point and where you come from, and I am not at all a believer in central planning in general, but I think that the failures of the governments are not due to difficulties for them to compute the appropriate EHAT, but more difficulties to impose them or to just make people vote for them in a sense. So I think that's I think in a sense whether ESG can bring value depends on what you believe are the main failures from the government actions. If it's just like traditional failures from planification, then it's true that ESG is not going to be a good substitute for government planification. But if these are failures due to political short-termism slash lack of coordination across countries, then it might help. So in a sense, I think the idea is maybe some kind of multilateralism at the investor level is easier to achieve because their interests are more aligned in a sense than it is at the country level, where cooperation has shown to be extremely difficult and very slow. But all your points are well taken, and we will actually take them into account when we rewrite the paper. So thanks a lot, and please send me the discussion, and maybe actually let's talk some more about it. I think this was a very very neat set of points that you made. So thank you.
Absolutely.
Thank you, Augustin. Do we have a question from the floor, from the panelists, or is there anyone who would like to? Martin has a.
There are two questions on the Q&A.
Right. What I was wondering about is, there's this one of the things I find really interesting about your model, Augustin, is that there's in the end no return sacrifice for impact, and that of course has been a controversial question. Some people, particularly practitioners, say there's this win-win situation. You can do better by being ESG. Then some empirical evidence, some theory, like my paper with Marcus says, you actually have to sacrifice if you want to have impact. And I find interesting that in your paper it's possible kind of with the same return. And could you give some more intuition what kind of the key driver is? Is it that in equilibrium all firms will behave and become clean? That's kind of all or nothing, the impact, or what would you say is kind of the key for this result? Because I think from a investor's perspective, it's quite important to think about that question of the return.
No, totally. So I think you got it. There is a little bit of a diamond paradox effect, right? So you announce ex ante the standards, and basically all the companies that can are going to comply with them. It doesn't have to be, so it is in the model I have shown, it's a symmetric equilibrium, and it's a bit, in that sense, it's very homogeneous. They all comply. But actually, and that's something maybe we should do in robustness, you can have heterogeneity on the cost of compliance, and you will have a mass of companies that choose not to comply just because it's too costly for them to comply. It complexifies the computation of the optimal threshold, but that's feasible. But the intuition is really that the search frictions introduce this sort of reluctance to give up on access to responsible capital. And I think when I think about, is it plausible economically? I mean, what I see is that all the big companies, in the S&P 500, in the DAX, in the CAC 40, they all take this pretty seriously, right? They have all started to apply to themselves standards that are above regulations, most of them. And so it has to be that these investors are able to, in a sense, impose, like some norms that are a bit above regulatory thresholds. And so I think there are two interpretations. So even the one you propose, which is that companies want to preserve current or future access to this pool of capital, or that there are very strong expectations on regulations becoming tighter. Or maybe a third one, which is that employees and customers might also be imposing their own preferences to companies. But I think it has to be a mix of these three things. But you are right. I mean, just to answer your question, so your point was right. Exact. Yeah.
Thank you so much. I suggest we take a 5-minute break and then start at 20 minutes to 4 in 5 minutes with the next paper. Thank you.
Thank you. Thanks a lot.